Today's market moves weren't really about improving economic conditions. What investors were reacting to was a growing willingness to tolerate inflation and higher interest rates as long as AI-driven earnings momentum continues holding up. The headline indices looked relatively calm on the surface. The S&P 500 gained a little more than 0.5%, while the Nasdaq outperformed again, rising just over 1%, driven largely by semiconductors and mega-cap technology. Meanwhile, the Dow actually finished lower, reflecting weakness in financials, utilities, and more economically sensitive sectors. But underneath those numbers, something more important was happening. Bond yields continued climbing after another hot inflation report. Producer prices came in far above expectations, reinforcing the idea that inflation may not cool as quickly as markets had hoped earlier this year. And normally, that kind of inflation surprise would pressure equities much more aggressively. Instead, investors kept buying technology. That tells us the market narrative is evolving. Earlier in the cycle, rising inflation automatically meant lower equity valuations because investors expected tighter monetary policy and slower growth. Now, the market appears to be saying something different. Investors seem increasingly willing to accept a higher for longer rate environment if they still believe AI-related productivity growth can sustain corporate earnings. That shift in psychology may have been the most important development of the day. You could see that clearly in sector leadership. Technology led again. Communication services also outperformed. Healthcare quietly attracted flows as well, suggesting some institutional investors are adding selective defensive exposure beneath the surface. But rate-sensitive sectors struggled badly. Utilities fell sharply. Financials weakened again. Real estate lagged. And that divergence matters because it suggests this is not a broad confidence rally tied to improving economic conditions. It's a concentrated allocation toward a very specific market narrative. AI infrastructure, cloud computing, semiconductor demand, large-cap companies with strong balance sheets and earnings visibility. In many ways, the market is becoming increasingly dependent on a narrow group of perceived structural winners. And no company represents that dynamic more than Nvidia. Nvidia has effectively become a proxy for global AI investment expectations. As long as investors believe enterprise AI spending remains strong, capital continues flowing aggressively into semiconductors and related infrastructure names. Reuters noted that semiconductor companies have contributed the majority of the S&P 500's market cap gains this year. That's an extraordinary level of concentration. In the short term, concentration can reinforce momentum, but structurally, it also creates fragility, because when leadership narrows this aggressively, the broader market becomes increasingly sensitive to disappointment from a very small number of companies. At the same time, another force continues building quietly underneath the surface: inflation persistence. Today's producer inflation surge was heavily tied to energy and supply chain disruptions connected to ongoing geopolitical tensions involving Iran, Israel, and broader Middle East logistics. Oil prices actually fell during the session, but bond markets largely ignored that short-term move. Treasury yields kept rising because investors are beginning to question whether inflation pressures are becoming more structural again. And importantly, bond markets now appear to be pricing out near-term Federal Reserve cuts more aggressively. The conversation is gradually shifting from when will rate cuts begin toward how long does restrictive policy remain in place. That's a meaningful change, because the entire growth rally over the past year has depended partly on the assumption that rates would eventually normalize lower. Yet, despite that repricing in bonds, equity investors continued leaning into risk. That disconnect between equities and fixed income may be one of the most important signals markets are sending right now. Another interesting development today was the market reaction to the summit between President Donald Trump and Chinese President Xi Jinping in Beijing. The presence of technology executives, including Jensen Huang and Elon Musk, raised optimism that tensions around semiconductor trade and AI supply chains may stabilize somewhat. Markets interpreted that as potentially positive for AI infrastructure spending and cross-border technology flows. And again, that reinforced the same dominant theme driving markets right now. Investors remain highly focused on preserving exposure to AI-led growth. But there are still important warning signs underneath the surface. Financials continue underperforming despite higher long-term yields. Historically, durable bull markets usually require healthy participation from banks and cyclicals because they reflect broader economic confidence and credit expansion. That confirmation is still missing. Instead, concerns around commercial real estate exposure, tighter lending conditions, funding costs, and credit quality continue weighing on the sector. That suggests liquidity conditions beneath the surface may not be as strong as headline indices imply. One open question investors are debating right now is whether this market is experiencing a temporary period of concentrated enthusiasm around AI or the early stages of a much broader structural repricing of growth expectations. I'd be curious how you see this developing. Do you think markets are correctly pricing the resilience of AI-driven earnings growth or underestimating the inflation and liquidity risks building underneath the surface? Looking ahead, the next major test for markets will likely come from inflation data, Federal Reserve communication, and upcoming earnings from AI infrastructure and cloud-related companies. If inflation continues broadening beyond energy-related categories, bond yields may continue rising and eventually pressure equity valuations more directly. But if AI earnings momentum remains strong enough to allow investors to continue tolerating tighter financial conditions longer than many expected earlier this year. For now, the broader takeaway from today's market reaction is that investors appear increasingly willing to prioritize productivity optimism over concerns about inflation and higher rates. But the market's strength is also becoming increasingly dependent on a narrow group of companies and a very concentrated growth narrative. And historically, concentrated leadership can be powerful but also fragile. If you enjoy this type of calm, analytical breakdown of global markets, consider subscribing. I publish regular briefings focused on the deeper forces shaping market behavior. And as always, thank you for spending a few minutes here today. I appreciate you being part of the channel.